Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel L. Connon, along with Brianna Valesky, and we have Michael Hewson on the line. He's a chief market analyst at CMC Markets. Michael, how you doing this morning?
Good morning, Brianna. Good morning, Joel. How are you?
We're doing
Still
good.
digesting last night's Fed decision, which I have to say didn't come as too much of a surprise to me, but it seems to have come as a bit of a surprise to a lot of other people.
Yeah, let's talk about it. You were covering it late last night for the BBC network. Give us your take on it, and also the implications for the ECB.
Well, yeah, this is it. I mean, I think what we've seen, the reaction of the market suggests that we've seen a very confused reaction to the decision. The Fed funds rate, I think, was the best guide to what the Fed was going to do last night, and that was really to keep interest rates on hold. And I think the market was focusing on completely the wrong thing. Everyone had been focusing on the unemployment numbers and the fact that they had improved. But for me, it was never really about the unemployment numbers. It's always been about the inflation, the lack of wage growth, or the very tepid wage growth that we've seen. And I think a lot of attention was placed on the improvement in the labour market, but what no one really talks about was the omission in the July statement of that paragraph about energy prices. In the June statement, there was a paragraph about energy prices are stabilising. That was removed from the July statement, and that told me that the Fed was concerned about the lack of inflation that was basically within the US economy, and that really should have sent out alarm bells to a whole host of other people. Now, obviously the improvement in the labour market is a positive thing, but even there, I think in some of the recent data I've noticed a little bit of weakness, certainly in the context of the Empire manufacturing data that we've seen in the past couple of months. The Philly Fed as well has been a little bit weak. So ultimately, I wasn't surprised that the Fed stayed on hold. The bond market's got it wrong, the FX market's got it wrong, and I think the likelihood is that the window for a rate hike this year is starting to close, because I don't think we'll see any movement in October, though I think Janet Yellen was very careful not to rule that out. But I think December is probably the earliest we're going to get something, and even then, that might be problematic, given I think that any further Chinese devaluation could actually keep pressure on price inflation, and then the Fed did guide its dot plots lower as well. So for me, not so much of a surprise, and now really the question is, what does this mean for equity markets overall? They certainly haven't reacted well to it, but it also gives problems to the European Central Bank. It gives problems to the Bank of Japan, because all of those dollar longs that have been pricing in a rate hike this year are now going to have to reassess that view, and that could push euro dollar up to 117 and dollar yen down to 116.
Okay, all right. We're getting in the chat here. Chris S. Tax is talking about the range that the Fed uses from 0 to 0.25, and he's asking about the implications of the Fed making use of the upper end of the range.
Well, I think what the Fed could have done, and I think this might have been sort of a half White House, is they could have actually moved the range up an eighth. So, say for example, called it an 8.375. And moved it that way. This range can be problematic, I think, in terms of how people view what the Fed is doing with respect to prices. I certainly think the market is a much better judge of rate expectations than the actual Fed funds rate. I think we fixate far too much on a rate that really has no relevance to the price of credit that you or I pay in terms of interest on deposits at the bank, or in terms of borrowing money for our mortgages or our HP or hire purchase. So for me, I think the Fed has shown that it's concerned at the tightening effect that the strength of the dollar has had, and I think that the Fed funds rate, I think if they had adjusted it higher, I think it would have given the impression that they were embarking on the first of a number of rate hiking cycles, and you can certainly see that in the way the dot plot charts. I think what was interesting about the dot plot charts was, though, that we got a negative in there, and I'm just wondering if that was Mr. Kosher Lakota being a little bit mischievous, given the fact he doesn't have a vote next year.
So what now? What now, Michael? I mean, we didn't get the raise in rates. Dennis and I threw in the towel and said, okay, we were convinced by all the banner. Now what? 15, 16, 17, never. Where do you stand on this?
When do I stand on this? I don't think we'll see one this year, to be honest with you. I think the Fed is absolutely terrified of the effect that a rate hike could have on the emerging markets. You've got trillions of dollars of short-term debt due to be rolled over, and I think that's why the markets are reacting the way that they are. I think that they're looking at the global economy and think, yeah, it's slowing down. Surely the U.S. economy can withstand a rate rise of 0.25% or whatever, and I think it probably can. Unfortunately, the world has changed. The world has changed since 2006 by quite some way. When the Fed embarked on that massive quantitative easing program between 2009 and 2013, they created a monster in terms of the amount of dollars that were in circulation. That monster can now threaten to come back and bite them. And now, from being the US central bank, it is now the global central bank. Whether they like it or not, it's a fact, because an awful lot of emerging market economies have an awful lot of US dollar denominated debt, and as a result, any move higher in interest rates could actually tip some of them over the edge, whether we like it or not. And now the Fed not only has to consider the US economy, it also has to consider the effects on the global economy.
Right, and now the ECB. I mean, what are the implications now? How are they going to adjust their plans for growth?
Well, we've already seen some evidence of that this morning. Benoit Cœuré has already been trying to talk the euro back down again by saying that the ECB is prepared to extend its quantitative easing program beyond the scheduled end date, September 2016. That's typical central bank jawboning. I expected nothing less from the ECB. We're certainly seeing some evidence of that taking some of the early froth off euro dollar, but we are above 114. I think we could slip back to 112, but I think the overall bias for euro dollar now is for probably a move higher towards around 117 or 118, and I think it's the same thing for dollar yen. The biggest question, I think, with respect to the ECB is what else can they buy? Because there isn't an unlimited pool of assets that the ECB can buy over and above of what they're already committed to buy. So what do they do next? How do they expand their asset pool? Do they buy equities? Do they buy German equities? Do they buy Italian equities? Do they buy Spanish equities? So to a certain extent, we've still got another year of ECB QE. I don't think they've got that much room to expand it beyond what they're already committed to. So I think the big question is, what else can they buy going forward? So expect to hear an awful lot of chatter about the ECB remains committed to take further action. I think the first indication we'll get of that is at the next ECB meeting next month.
All right, moving on here. Where to put your money now? And Goldman Sachs says not to put your money in crude oil. They're calling for $20 crude oil. Made this call last week.
Yeah, I don't buy that.
Yeah, I'm sorry. What's your comment on that?
I don't buy that at all. I mean, to be fair to Goldman Sachs, they said that wasn't their base case scenario. I mean, at the moment, we still haven't gone through the 2008 and 2009 lows. Now, a weaker dollar actually feeds in to a wider narrative of firmer commodity prices. Now, at the moment, if I'm looking at WTI crude, Joel, I'm looking at the support level from around about $43 a barrel, which has held the crude price up for around about the last 2 or 3 weeks. But then we've got the lows that we saw in August around about $37 a barrel. So obviously that's the next key support level. But really below that, we've got the 2008 lows, which come in around about $35 a barrel. So there is an awful lot of support levels that we have to get through before we even get to $20 a barrel. So, I really don't see a scenario where that can happen. Now, I could be wrong about that. I've been wrong before. I wasn't wrong about the Fed. I was wrong about the ECB printing an awful lot of money. So, it can go either way. But I've got to say, I think by the time we get back down to 30, 35, 37, $38 a barrel, I think OPEC will probably be brawling in the streets trying to cut production, because I think that could create an awful lot of tensions within OPEC and non-OPEC countries as a whole. So, oil prices down at $20 a barrel, I would be very surprised
Me
if that
too.
happened.
Okay, so you're getting the gold market here. Is this finally the day, the week, the month, the year where gold gets off the mat here? Made several lows under 1100, came back down to 1100 just last week, maybe earlier in this week. Now we're taking off. Is it finally time to put some faith in the gold market?
At the moment, if you look at a daily chart on gold, we are trading in a triangular consolidation. If you draw a line through the lows from the highs in 2015, draw a line from the January highs 2015, that basically comes in just above where we are now, around about $1,150 an ounce. You can also draw a line through the lows in July. There was good support there. If we break to the top side around about 1154, then I think we can go for a run to the top side towards the 200-day moving average at around about 1180. So we've been in a downtrend since the highs in January. If we break above that trend line that I've drawn in on the daily chart through those highs, then we can break higher. But at the moment, we're in a consolidation, in a downtrend. But for me, the triangular consolidation, really, you trade the breakout. And the breakout for me, we've seen 3 strong positive up days. I think if we break above 1150, we can go for a run to the top side. But for me, I think the bias is to the upside in gold and not the downside.
Okay, all right. We are on the line with Michael Hewson. He's the chief market analyst at CMC Markets. Going back to the Fed, I mean, do you think that what's going on in China, with their devaluation, you think that, that they're expanding their mandate and, looking at other things besides their dual mandate to make their decisions?
I think the Fed does have its eye on what's going on in China. I think Janet Yellen touched upon it in her press conference last night. I can't remember the exact language she used, but I think there was a concern that the Chinese authorities might mishandle the slowdown in their economy. I think it really depends on whether or not you believe all of the Chinese data that's been coming out with respect to the Chinese economy. Now, next week, we have a manufacturing PMI number from the Caixin survey. Now, that Caixin survey was the survey that showed manufacturing output at a 77-month low, which sort of coincided with the easing of the policy band against the US dollar. So I think what we're going to see is a gradual weakening of the yuan against the dollar. But I think it will happen after the Chinese leader has done all his little visits to various Western officials. I don't think he's going to want to rock the boat before he's done all his little visits around the G7 countries. He'll wait because he won't want to have a difficult conversation with anyone about manipulating the currency. But ultimately, one of the reasons I think the Chinese economy is having the problems that it is having was because it was pegged too closely to the dollar. And if you look at what the dollar's done over the past 2 years, it's 20% higher than it was at the beginning of 2014, and that has actually hurt Chinese exports simply because of the fact that euro-dollar has come down around about the same amount. So it's lost its competitiveness against Europe, and it's lost its competitive against Japan. And that's why you're seeing Chinese authorities taking many steps to try and weaken it a little bit, while at the same time trying to pump extra stimulus into the economy. Now, time will tell whether that will be successful, but certainly I think next week we get that manufacturing PMI. It'll be the first PMI after the Tianjin blast and all of the port problems that they had with respect to that, and we should get some idea of whether or not it's having an effect.
All right. So what now for, U.S. investors? I know you follow, the U.S. stock markets and gold and commodities and whatnot. I don't know. I mean, do you just sit tight here and higher percent of cash and, wait for a retest of the flash crash lows? Are there any sectors or individual issues that are catching your eye?
Well, I was expecting a question like this, Joel, and to be quite, I still think U.S. stocks are probably overvalued in pockets, and certainly I think if I'm looking at the S&P 500, I would certainly be expecting a retest of the 1900 level over the course of the next few sessions. But there are some stocks out there, and I was certainly looking at a stock that over here in the UK, which has been beaten down quite a lot in recent months, and that's Rolls-Royce. So it pays a decent dividend. It's been absolutely battered into oblivion since it peaked at around about £12 earlier this year, and it's trading around about £7. And ultimately, it's one of those stocks that I think over the long term generally pays a decent dividend and actually has a fairly healthy order book. But usually, as with any sell-off in a stock market, good stocks basically get caught up in the rout with any bad stocks. The problem is you end up trying to pick the base. I'm never a big fan of doing things like that. Sometimes I think it helps to sit on cash and wait for the volatility to subside. I don't think we're there yet. In my note this morning, I said the Fed hold just prolongs the melodrama, and I think that's absolutely right. We're no clearer now as to when the Fed is going to raise rates, even if they do. And I have my doubts about that, because I think if they were going to go, they should have gone last night, because I don't think October is even in play. And as for December, is she going to really raise rates just before Christmas?
Now I know that's something that we talked about on yesterday's show was, if they didn't do it now, were they going to do it at Christmas, at that time, and at just the timing of it. Well, the markets are reacting very negatively this morning. The S&Ps are down 30 handles here. Coming into some support down at Monday and Tuesday's lows, but I have to agree with you, Michael. Thanks for the input on all the markets. We always enjoy having you on.
My pleasure, Joe.
Take it easy. Have a good weekend. We'll talk to you again soon.
Thanks, guys. Thanks, Brianna. Thanks, Joe.